So as we think about these 6 tenets of Dow theory, let's break them down. I'm going to give you all to you at once, and then we'll dive into each of them and kind of expand upon each of them. So the 6 tenets are, in order, number 1, the price discounts everything. Number 2, the market has 3 trends. Number 3, the trends have 3 phases to the trend. The averages must confirm each other. Number 5, volume must confirm the trend. And number 6, a trend is assumed to be in effect until it's given definite signals that it has reversed. So let's look at each of these in detail, and then I'm going to really expand upon the third one kind of in the next video that we're going to do. So first, let's understand the price discounts everything. This is really the technician's viewpoint on the efficient market hypothesis, that everything that can be known is already known about it. The way Charles Dow said it is he said everything that can be known has already been factored in, therefore all that news has been discounted. All of that information has been discounted, it's been factored in, and the only thing that remains is human emotion. So there's 2 bullet points here. All known information that can be known has already been factored in, and the only remaining influence on stock price is human emotion. Consequently, we're studying human emotion, not the statistical data. We're studying the price action, which reflects that human emotion. And the statistics, they're just kind of there. Yeah, they're true. Yeah, there's some fundamental information that came out. It influences the stock, but it got factored in really, really fast. And now the only thing that's left is speculation, human emotion. That's it. That's what the first principle, the price discounts everything, says. And as a technician, pretty much all technicians ascribe to this theory because it's the foundation of all technical trading. The second principle of Dow theory is that there are 3 trends at any given time that are working together. And those 3 trends are the primary, the secondary, also known as the intermediate trend, and the minor level trend. So we got the primary, secondary, and minor level trend. And on any chart at any time, these 3 trends are at play and they're working together. So let's understand them a little bit. The primary trend is the big picture trend. This is the trend that's going to go on a daily chart for at least a year or more. It's the major trend. It's the big picture. It's going to involve extensive up movements and extensive down movements. And again, it's going to last, generally speaking, at least a year or more. Now, in terms of price action, the general result is that it's going to move at least 20% or more. So if you've got a primary trend over the course of a year that's taking place, that primary trend is going to increase at least 20% over the course of a year. Usually it's substantially more, but a minimum of 20%. And the same thing would be true if it was a primary downtrend. A primary downtrend or a primary bear trend would be at least a 20% correction in the stock at the very minimum, and time-wise it's going to go over the course of a year or more, generally speaking. Now the second level is what we call the secondary or the intermediate level trend. This level of the trend is going to be a little bit smaller. It's going to typically last anywhere from a few weeks up to maybe 6 or 8 or 9 months. And you're going to notice, if you look at my image here, we've got the primary trend, that's the black line here, and then you got the blue trend. Well, the blue trend is reacting to it. So at times, the intermediate trend is moving bullish with the primary trend, as you see in here, and then at times it's reacting to it. And that's really the way we define the intermediate trend. It's a reactionary trend to the primary trend. So sometimes it's moving in the same direction as the primary trend, sometimes it's moving against it, but when it resumes, you notice that it's picking up in there with the primary trend, and so you've got up movement and down movement, up movement and down movement. It's all working together with the primary, but again, it's sometimes going against the primary, sometimes. Generally speaking, we can say that this move is going to constitute anywhere from 30 to 100% of the previous move in the primary trend. Now, what does that mean? Let me visually show this and maybe it makes more sense. If you notice the blue first wave of the intermediate move, the reactionary move, that's the second wave of this here, it should correct anywhere from 30% up to 100%, but it should not correct more than that. So that secondary wave will correct as much as 100% of the initial thrust in the primary direction, but not more than 100%. And that's the way that you can think about that. So the intermediate wave, if it's correcting more than 100%, something else is happening, and you might need to relook at the level of analysis on that. But if it's correcting anywhere from 30 to 100%, it can still be part of that intermediate level of the move. Now the third trend, the third move that's happening here is the minor level trend. And the minor level trend is functionally going to work relative to the intermediate trend the same way that the intermediate trend works in relationship to the primary trend. So the minor moves are going to be small moves up and down. They're working with the intermediate trend, but they're not necessarily superseding the intermediate trend. And again, the intermediate trend is working with the primary trend. And so you have this relationship here. These are going to be typically moves that last anywhere from a few days up to 2 to 4 weeks, 2 to 3 weeks, somewhere in that range. And you've seen them in the price action of your stock. It goes up, goes down, goes up, and goes down. And then you kind of have a trend reversal. And then it kind of reverses, and you got kind of a bigger trend that's happening. You're dealing with the minor level, the intermediate level, and the primary level of the trend. Now, these minor level moves are very much like the intermediate. Each wave of that minor level move, the reaction wave, is going to result in a 30 to 100% of the first wave that's part of that intermediate move. And so it's not going to retrace more than that. If it retraces more than that, then something else is happening and you're getting outside of the minor level of the trend. All right, let's look at an example so we can kind of take this out of the theoretical world and more into the real world. So look at this trade on Archer Daniels, and notice up here at the top, you see where we've got kind of the beginning of the trend, and then several months later we hit that point again. This is your big picture primary trend, and it's easy to see. Once you mark it out, it's like, oh, that's it. Most of the time when you draw trend lines on a chart, you're probably drawing a primary trend more often than not. That's just the big picture trend. Now let's look at another level. Let's take another line through here, and you see the blue line that I'm drawing. This is the intermediate level, and you notice how the intermediate level, at first it's selling off really fast with the primary trend, and then it reacts, kind of picks up that primary trend angle. It continues the move, and later it will react again. You also notice how the intermediate level, it did retrace a substantial portion of the first wave of the intermediate. It retraced a good part of that, but it did not take over the primary trend, and it didn't retrace more than 100% of the intermediate level. And so there's the intermediate, and you see how that's working. Now notice that the price action looks nothing like the primary trend line, looks nothing like the intermediate trend line. What's the price action look like? It looks like the little candles that are going up and down, and we call that the minor trend. Look at these kind of bronzy, whatever color you want to call that there, and it's just the day-to-day zigs and zags. If you wanted to really identify the minor level more than anything, just click on a line chart, and that's pretty much going to be the picture of your minor level of the trend on a daily chart, and that's the way it's going to look. So your minor levels, the very small moves day to day. The trend themselves is typically going to last anywhere from a couple days up to maybe a week or 2 or 3. Intermediates, much bigger. The minor level works with the intermediate trend, as you can see on this picture, but it doesn't supersede it. And the intermediate trend works with the primary trend, but it doesn't supersede it. In fact, while I'm talking about this, let me give you a little analogy that Charles Dow used to give. He used the analogy that the levels of the trend are a lot like the waves of the ocean. He said, you got the tide. The tide comes in, the tide goes out, it comes in, and that's the primary movement of the ocean. And he says in the stock market, the primary movement would be kind of the primary trend. That would be the tidal movement, if you would, of the stock market. Now, the second level of the ocean, the secondary wave of the ocean, would be the waves that you see on the ocean. And so you got the waves that are going up and down. And if the tide's coming in, well, the waves are coming in with it, but the waves are still going up and down. And if the tide's going out, the waves are still going up and down, but they're going out with the tide. It says the same principle is true with the intermediate level. The intermediate level trend is a lot like the waves of the ocean. And so the intermediate is kind of the waves of the market, while the primary is kind of the tide of the market. And then the third part there, the minor level, he says it's like the ripples on top of the waves, on top of the tide, on top of the ocean. And so, the tide comes in, it goes out. That doesn't supersede the waves, but it carries the waves with it. The waves go up and down, and then you've got the little ripples on the waves that are going up and down. They ride with the waves that are riding with the tide. And so the minor level is riding with the intermediate level that's riding with the primary level in the market, if you can follow that little analogy there. And maybe that gives you a good pictorial idea of what's happening. Okay, so now that we understand the 3 levels of the trend, primary, intermediate, and minor, let's learn about the third tenet of Dow theory, which talks about the phases of the trend. And we say that the trends have 3 phases of the trend, and those 3 phases break down as follows: the accumulation phase, the public participation phase, and the distribution phase. So yes, we got 3 levels of the trend, and we got 3 phases of the trend. Those are the phases that are happening inside that trend. Now, I don't want to talk too much about the phases of the trend right now. now. I'm going to come back, and in the next video, it's all going to be about the three phases of the trend. So let's go straight over to the fourth tenet here. In the fourth tenet of Dow theory, it says that the averages must confirm each other. Now, what does that mean? Remember I said earlier that Charles Dow created the industrial average, right? The Dow Jones Industrial Average. Well, they also created an average called the transportation average. And while the industrials had all the industrial companies, the transports average had all the railroads and the transportation companies. That's evolved over time. We've put different stocks in there, but it's still the same principle. We've got the Dow Jones Industrial that kind of represents industry, and we've got the Dow Jones Transports that really represents transportation. So how's this theory work? Well, the theory goes like this. If industry is producing goods, then industry needs to sell those goods, and consequently, the transportation needs to deliver the goods. So if the transports go down, then the theory goes that the transports aren't delivering as much of the goods. Consequently, industry is about to follow. And so the theory goes like this. The averages need to be moving in the same direction. If the transports and the industrials are moving up, then all things should be good. Markets are in agreement. If the transports start to go down and the industrials keep going up, we've got a divergence, something's not right. There could be a big change coming pretty soon. That's the idea, that's the theory behind it. And so if we were to look at the slides here, two Dow Jones averages must agree, the transports and the industrial, they must confirm each other. If they're not in confirmation, then the overall direction is going to be suspect. Let's take a look here if I zoom in at this image. And you're going to notice back in 2007, I've got it highlighted in yellow, but I'm going to draw your attention to it. Notice in 2007, across the top, the industrials kept making a higher high, and the transports were making a lower high. So the transports turned several months before the industrials turned. Eventually, they got back in sync together, and they actually crashed together. But the first divergence actually happened several months before the big crash started to happen, and that was potentially one of the ideas or one of the warning signals that we had there. Look over here in 2012, we had a similar situation where the industrials kept making a higher high and the transports were making a lower high. Now this one did not play out into a huge correction. It did kind of move into some consolidation, but we didn't have a huge sell-off like we had in 2008. But still, they did get out of sync, and that represented some lack of congruency in the market. That's the fourth tenet, fourth principle of Dow theory. Now let's look at the fifth principle, fifth tenet of Dow theory, and it says that volume must confirm the trend. What does that mean? Well, I told you earlier, in technical trading, there's only two things we can really look at: the price of the stock and the volume. That is how many shares are being traded. And so the theory goes like this. Volume should be moving in the direction of the trend that is happening. If people are buying, we should see an increase in volume. If we see an increase in volume, then that tells us a lot of people are buying. If people are starting to sell, we should see an increase in volume. The increase in selling pressure tells us that trend is starting to move over into selling momentum here. And so the theory goes like this. Volume must confirm the trend. Volume is assumed to move in the direction of the masses. Whichever direction the majority of market participants are going, that's the assumption that the volume is going with that. And so weak volume indicates a potential weak trend, whereas strong volume indicates a potentially strong trend. So the idea here is that we want, in an upward market, in a bull market, we want the trend or the movement of the volume to be increasing. In a downward market, we want the trend of the volume to be increasing as well. In both cases, you want the volume increasing. Take a look here. This was a bit of a bullish trend, and let me draw your attention to the volume spikes that happened while the market was moving up. And then in the red area, the market moved sideways, and look at how volume consolidated a little bit. Then we get into a little bullish swing here, and look at how the volume is increasing. We get into a sideways move, and look what happens. The volume contracts. Now we start to get into a little bit of a bearish swing, and look, volume is moving with that. Volume stopped moving when we got into the kind of sideways part. And then as we got into this yellow area, volume overall kind of declined, and the stock itself didn't really go anywhere. And then we started a bit of a decline in the next green area, and look how the volume came back in to join that. And so again, the principle is that volume needs to move with the majority of the masses. If the trend is going up, you kind of want the volume coming up with it. Trend's going down, you really want the volume to help confirm that as well. All right, that brings us to the sixth principle of Dow theory, which says this: trends tend to stay in motion. A trend is assumed to be in effect until it gives definite signals that it has reversed. How many times have you heard the trend is your friend? It comes right back to Dow theory. A trend is assumed to be in effect until it's given definite signals of a reversal. Now, how do we know when that reversal happens? Well, that's what our entire program is about, determining the reversal. We use our 5 steps of trade confirmation for that. But the principle here is that we're going to stay with a trend. We want to stay in the general direction of a trend until it's given definite signals that that trend has reversed. Another way of thinking about this is kind of like the laws of physics. An object in motion tends to stay in motion. Well, we could say a trend in motion tends to stay in motion. And as long as that trend is happening, we're going to assume that the predominant direction is still in the direction of that trend. So we assume that is all happening. That's what the 6th tenet and the 6th principle of Dow theory talks about. Take a look at this example here and notice how the downtrend is happening here. And so we have a lot of, we've got a big primary downtrend, obviously. We've got a lot of downward movement. We've got some upward movement, a lot of downward movement, some upward movement. But the predominant trend is still in effect. And that's a great picture of how the trend is assumed to be in effect. So the general principle, how we normally apply it, is we try not to trade against the trend until we know the trend has reversed. So we assume the big picture trend is in effect. That's going to usually be the primary trend, and we're going to try to avoid trading against that predominant trend.